If the stock market crashed tomorrow and lost 50% of its value, your 401k would lose 50% of its value too. That's not fear-mongering, that's just math. And if you're anywhere near retirement or already retired, that's a math problem that could destroy your golden years. I'm going to show you exactly what happens to your 401k when the market crashes, and more importantly, the 3 moves you need to make right now to protect yourself. Hi folks, I'm here today to have an honest conversation about something that keeps a lot of people our age up at night. What happens to our 401k when the market takes a nosedive? Now, I've been helping people navigate their retirement planning for over 2 decades, and I've seen this movie before. I was there in 2008, I was there in 2000, and I can tell you that the people who were prepared weathered those storms much better than those who weren't. Today, I'm going to make sure you're in that first group. Let me start with a question that might make you uncomfortable. Do you know exactly what percentage of your 401k is invested in the stock market right now? If you're like most Americans, you probably don't have a precise answer. And that's part of the problem. Most 401k plans are heavily weighted toward stocks, sometimes 60, 70, even 80% or more. That means when the stock market has a good day, you have a good day. But when the stock market has a terrible year, well, you have a terrible year too. The harsh reality is that your 401k isn't some magical separate entity that's protected from market volatility. It's directly tied to the performance of the investments inside it. And for most people, that means it's directly tied to the stock market. So what exactly happens when the market crashes? Let's walk through this step by step, because understanding the mechanics will help you make better decisions. When the stock market drops, the value of the stocks in your 401k drops by the same amount. It's that simple. If you have $500,000 in your 401k and 70% of it is in stocks, that means you have $350,000 exposed to stock market risk. If the market drops 30%, you don't lose 30% of your total 401k. You lose 30% of that $350,000, which is $105,000. Your 401k balance would drop from $500,000 to $395,000. Now, that might not sound catastrophic, but here's where it gets scary for people near or in retirement. If you're retired and taking withdrawals from that 401k to live on, you're now withdrawing from a smaller pot of money. This creates what we call the sequence of returns risk. You're selling shares when they're down to pay for your living expenses, and those shares can't recover because you no longer own them. It's like being forced to sell your house during a housing crash. You're locking in those losses. But here's what really keeps me up at night on behalf of people like you. Most folks don't just lose money during a market crash. They lose time. And time is the one thing we can't get back. Let me give you some real examples so this isn't just theoretical. In 2008, the S&P 500 dropped about 37% in 1 year. If you had $400,000 in your 401k and it was heavily invested in stocks, you could have watched it drop to around $252,000. That's $148,000 gone in 12 months. Now, the market did recover. It always has so far. But it took about 4 years to get back to where it was. 4 years. If you were 65 in 2008, you were 69 before your account recovered, and that's assuming you didn't take any withdrawals during that time. The dot-com crash from 2000 to 2002 was even worse for some investors. The Nasdaq lost about 78% of its value. People who were heavily invested in technology stocks, and remember, tech stocks were all the rage back then, just like they are now, saw their retirement accounts decimated. It took until 2015 for the Nasdaq to fully recover to its 2000 highs. 15 years. Think about that. If you were 55 in 2000, you were 70 before your tech-heavy portfolio recovered. I've put together a complete historical analysis of how different portfolio allocations performed during these crashes, and you can find that in the description below. Now, I don't want to scare you, but I do want you to be prepared. So let's talk about the 3 moves you need to make right now to protect your 401k from the next market crash. And notice I said next crash, not if there's a crash. Market crashes happen. They're as much a part of investing as compound interest. The question isn't whether there will be another crash. The question is when, and will you be ready? Move number 1, diversify beyond stocks, and I mean really diversify. Most people think they're diversified because they own both large cap and small cap stocks, or because they have both growth and value stocks. That's not diversification. That's just owning different flavors of the same thing. When the stock market crashes, pretty much all stocks go down together. Real diversification means owning assets that don't move in lockstep with the stock market. This might include bonds, but not just any bonds. You want to understand what types of bonds actually provide protection during market turmoil. It might include Treasury inflation-protected securities, or TIPS. It might include precious metals like gold and silver, which often move opposite to stocks. It might include real estate investment trusts, though you need to be careful because REITs can sometimes move with stocks during major crashes. The key is to own assets that have historically held their value or even gone up when stocks are going down. Now, your 401k might have limited options for this kind of diversification, which brings me to an important point. You might need to look beyond your 401k for some of this protection. Here's what this looks like practically. Instead of having 70% stocks and 30% bonds, you might consider something like 40% stocks, 20% bonds, 15% precious metals, 15% cash or cash equivalents, and 10% in alternative investments. Now, this is just an example. Your exact allocation should depend on your age, your risk tolerance, and how close you are to retirement. But the principle is the same. Don't put all your eggs in the stock market basket. The company I personally work with for precious metals diversification, and I'll link them in the description below, has been helping retirees protect their wealth for over a decade. Move number 2, build a cash safety net that's completely separate from your 401k. This is what I call your sleep well at night fund. Here's why this is so important. During a market crash, you don't want to be forced to sell your investments when they're down. But life doesn't stop just because the market crashed. You still need to pay your mortgage, buy groceries, cover medical expenses. If you have enough cash set aside to cover your expenses for 1 to 2 years, you can ride out the storm without touching your crashed 401k. Now, I know what some of you are thinking. Cash doesn't earn anything, and with inflation, I'm actually losing money. You're not wrong. But think of this cash not as an investment. Think of it as insurance. You pay for car insurance hoping you'll never need it, right? This cash safety net is insurance against being forced to sell your investments at the worst possible time. How much cash should you have? If you're still working, 3 to 6 months of expenses is usually enough. But if you're retired or close to retirement, I recommend having 12 to 24 months of expenses in cash. Where should you keep this cash? Not under your mattress, and probably not in a regular savings account earning 0.01% interest. Look for high-yield savings accounts, money market accounts, or short-term CDs. You want your cash to be completely safe, but earning as much as possible while staying liquid. Some online banks are offering 4% or 5% on savings accounts right now. That's not going to make you rich, but it's a lot better than keeping it in a big bank savings account earning nothing. Move number 3, review and rebalance your portfolio regularly and adjust your risk as you get older. This sounds simple, but most people set up their 401k once and then ignore it for years. That's a mistake that can cost you dearly. As you get closer to retirement, you should generally be taking less risk, not more. But here's what happens to a lot of people. Let's say you start with 60% stocks and 40% bonds. The stock market does well for a few years, and now your portfolio has drifted to 75% stocks and 25% bonds. You're actually taking more risk than you intended, right when you should be taking less. This is why you need to rebalance. At least once a year, look at your allocation and get it back to your target. This forces you to sell high and buy low, which is exactly what you want to do. But beyond just rebalancing, you should be reassessing your overall risk level as you age. There's an old rule of thumb that says you should have your age in bonds. So if you're 65, you should have 65% bonds and 35% stocks. Now that might be too conservative for some people, especially with people living longer these days. But the principle is sound. As you get older, you should generally be taking less risk. Here's a practical way to think about this. Divide your investing life into phases. In your 50s, you might be comfortable with 60 to 70% stocks. In your 60s, maybe 40 to 50% stocks. In your 70s and beyond, maybe 20 to 30% stocks. These are just guidelines. Your exact allocation should depend on your specific situation. But the key is to have a plan and stick to it. Don't let fear or greed drive your decisions. If you want to see the exact age-based allocation checklist I use with my clients, I've included it in the description below. Now let me address a few additional things you should consider. First, if your company offers a match on your 401k contributions, don't stop contributing just because you're worried about a crash. That match is free money, and you should always take free money. But you might consider reducing your contribution to just get the match, and then diversifying your additional savings outside the 401k where you have more investment options. Second, consider Roth conversions if you have traditional 401k or IRA money. This is a complex topic, but here's the basic idea. If the market does crash and your account values are down, that might be an opportune time to convert some of that money to a Roth IRA. You'll pay taxes on the conversion, but you'll be paying taxes on the lower, post-crash value. When the market recovers, all that growth happens in your Roth account, tax-free. This is an advanced strategy, and you should definitely talk to a tax professional before doing it. Let me also tell you what not to do if the market crashes. Don't panic and sell everything. I know it's easier said than done, but panic selling is how people turn temporary losses into permanent ones. Don't try to time the market by jumping in and out. You'll likely get it wrong and end up buying high and selling low. Don't ignore your statements and hope things get better. Stay informed, but don't obsess over daily market movements. And don't assume the government or your employer is going to bail you out. Your retirement security is your responsibility. Let me summarize what we've covered today. Your 401k is directly tied to the stock market, which means when the market crashes, your 401k crashes too. This has happened before, and it will happen again. But you can protect yourself by taking 3 key actions. First, diversify beyond just stocks into assets that don't move in lockstep with the market. Second, build a substantial cash safety net so you're not forced to sell investments when they're down. And third, regularly review and rebalance your portfolio, reducing risk as you get older. The most important thing you can do right now is take action. Don't wait for the next crash to start preparing. By then, it's too late. Log into your 401k account this week and see exactly what you're invested in. Calculate how much cash you have readily available. Think honestly about whether you can afford to lose 30, 40, or 50% of your retirement savings and still maintain your lifestyle. If the answer is no, then you need to make changes now, while the market is relatively stable and you have time to plan. Remember, I'm not trying to scare you away from investing. The stock market has been the greatest wealth-building tool in history, and it will likely continue to be for decades to come. But blind faith in the market without proper preparation is not a retirement strategy. It's gambling with your future. You've worked too hard for too many years to let a market crash destroy your golden years. Take control of your financial future while you still can. Don't forget to check the description for your free 401k protection checklist and subscribe for more retirement protection strategies. I'll see you in the next video.